Welcome, everyone. This is Steve Elwell, the Chief Investment Officer and Partner at Level Financial Advisors. And I've got Paul Coleman, one of our certified financial planners, here with me. We're going to walk through the CARES Act as it applies to individuals, which is the vast majority of our clients, mostly people that are about to retire or recently retired. So we want to go through all of the individual pieces that affect different aspects of your financial life as it applies to the CARES Act, which has a lot of moving pieces. We're not really going to touch too much on the business aspect and the different loan programs and payroll tax deferral and tax credits or retention credits and all that as it applies to business owners. We're not going to touch that in this webinar. We're really going to stick to the individual side of things as it applies to the CARES Act. So first, before we get started, we always have to go through some important disclosure. Level Financial is neither a law firm nor an accounting firm, and no portion of its services should be construed as legal or accounting advice. Moreover, you should not assume that any discussion or information contained in this presentation serves as the receipt of or the substitute for personal investment advice from Level Financial. So always take all of this as general information, and then if you have specific questions about your scenario, talk to your advisor, talk to your accountant, talk to your attorney to make sure that what you're doing is correct for your own situation. So Paul, let's jump into it a little bit here. We've got a whole agenda to cover. There's a lot of good things in here that we want to walk through. So first, what is the CARES Act? The tax deadline changes, because those have moved. There's changes for required distributions. There's now the ability to take penalty-free IRA withdrawals and 401k loans and deferred payments for 401k loans. There's the stimulus checks, the tax rebate checks. So most people, I think they estimated about 90% of people will be getting rebate checks over the next couple of weeks and months. They've changed charitable deduction limits. They've created a new charitable deduction. They've provided student loan relief and grant relief. They've changed medical expenses and Medicare changes and unemployment. They've extended that and increased the amount paid. So let's hop right into it. First, Paul, you want to give us a walk down of exactly what is the CARES Act?
Yeah, so the CARES Act stands for Coronavirus Aid, Relief, and Economic Security Act. It was a little more than a $2 trillion emergency stimulus package that the House and the Senate and then the President passed and signed into law a week ago on the 27th, March 27th. It's almost 3 times larger than the 2008 TARP stimulus package. It includes relief for individuals, businesses and organizations, and it provides funding for various government agencies to address these crises.
Yeah, they're really, I mean, between the CARES Act that Congress passed and the President signed and the actions of the Federal Reserve, which as a reminder has reinstituted many of the programs to provide liquidity to the investment and financial markets, and has also cut interest rates by 1.5% over the last couple of weeks in March or throughout the month of March, and is doing unlimited quantitative easing where they're buying longer term bonds to bring down virtually all interest rates. You know, the government has effectively thrown everything it has at this problem. And I think the government is doing the best it can through all the different programs and things it's done to try and keep the economy afloat and keep people working or having access to money to pay their bills, cover their expenses, and keep businesses open while we work our way through everything that's happening with the coronavirus. Because I think most people recognize that if you can solve the health issues and hospital issues as it pertains to the coronavirus, then ultimately you can get people back to working, you can get businesses open back up, you can get restaurants open back up. It's kind of, I don't know if I want to say weathering the storm, but they're trying to provide relief in every way that they can to help people be able to weather the storm. So once we get through this, we can get back to sort of a more normal scenario where you don't have a protracted economic decline because we didn't provide some temporary relief to businesses or individuals to help them get through what hopefully is only a couple of months of economic shutdown.
Yeah,
So
I would add,
let's walk
sorry,
in.
Steve, I was
Yeah, go
going
ahead.
to add to that, that I collection of the lessons learned during the 2007 through 9 financial crisis. As you mentioned, we're seeing a lot of the same tools used, but we're seeing them launched much more quickly and much more effectively. So that bodes well for our economic future.
Yeah, I would totally agree with that, Paul. That's a good point. So we're in the middle of tax season, Paul. This is like the worst possible time to have, an economic downturn, to have everybody be locked down. People are trying to get their tax returns done. The deadline is quickly approaching, or was quickly approaching. We're recording this on April 3rd. The original deadline is April 15th, unless you had already extended your tax return. So, we were looking at about 2 weeks away when people are already dealing with, concerns about their own health and their family's health, potential job losses or slowdowns or business closures, to try and file your taxes at the exact same time when you may not even be able to go to your accountant's office is a headache. So one of the first things they did was the IRS said, and this was not in the bill, they just did it. They've changed the deadlines here for 2019 tax return filing. So Paul, you want to walk me through some of these pieces of this they've changed?
Yeah, so as you mentioned, the original deadline is April 15th. They've moved that to July 15th. So this includes filing your taxes, paying any tax payment that was due, making IRA contributions for the 2019 tax year, HSA contributions. And one important thing to note, if you're expecting a refund, you should still file your taxes as early as possible to get that refund, because they're not delaying refund payments.
Yeah, that's a good point, Paul. In fact, I have heard from some individuals, and this is just anecdotal, that they're processing returns faster than what they normally do this time of year because so many less people are actually filing at the current moment, knowing that they've got an extra 3 months to get it done. So that's kind of an interesting aspect. And if you're due money back from the federal or state government, then obviously you want that money as soon as possible. So, filing as soon as possible still makes sense. It's important to note for anyone who does delay filing their return until May or June, or even as late as possible, July 15th, there will be no penalty. There'll be no interest charged. If you owe the government money, it's not as if you will owe them more because they're going to charge you interest because you waited an extra 2 or 3 months to file. So that's really important to note. It's not like there's a negative for individuals. And if you owe a lot of money, being able to get those couple of extra months may be really valuable to you, to hold on to your own money for a couple of months, as a lot of people are being forced to make some tough financial decisions. All right, next, here's a big one. They have made major changes to required distributions for 2020. So let's jump into these, Paul. Do you want to cover a couple of these?
Yeah, absolutely. This is kind of a fun one because it opens up some planning opportunities for some of the clients, and we'll talk about that later in this presentation. But your required minimum distributions, anything that was due in 2020, can now be waived. So you can still take those if you would like, but you do not have to. That includes RMDs from traditional IRAs, SEP, and our simple IRAs, 401ks, 403bs, and 457. Basically, anybody that has an employer plan can skip their RMDs if they need to. This also includes beneficiary IRAs, which is an inherited IRA. Also of note, if you were one of the small number of people that would have had your first RMD due in 2019, but you postponed taking that until the following year, which is a tax strategy that can only be used in year number 1 of RMDs. You also can now skip that RMD, which would have been a 2019 due April 1st of 20. So for that very lucky, very small number of people, you're able to waive or skip 2 RMDs. And also, it's important to note that you can still take money from your IRAs if needed. You just don't have to. And qualified charitable distributions are still allowed as well, which is where you can take money past age 70.5 directly from an IRA and give it directly to a charity.
That's right. And not only when you give it to the charity, it's not counted as taxable income, which is, really a nice strategy because not too many people itemize anymore. So when they're making cash donations, just like by writing a check or using their credit card, they may not actually be getting a deduction. But if they do the QCD, then they will actually save money on taxes by doing that. This is interesting too because they did this in 2008 as well. And when they did it back then, they didn't actually pass it, if I remember right, until December of that year. So that really kind of stuck everybody because most people had already taken the required distribution by December. Here we are with this, economic downturn and stock market downturn, and they passed this as of the end of March. Well, obviously by the end of March, much less people have fulfilled the required distribution because we're only 3 months into the year. So this actually will affect, I think, a lot more people than what it did the last time they did it, because last time they did it so late in the year. So this is a big one, and I think we're going to circle back into some of the planning opportunities for this, and there are a lot of planning opportunities with this. But the key is, I think that Paul was touching on, is you now have the flexibility. You're not required to do anything. So you can do what's best for you in this particular year, and maybe that means you still take it, and maybe that means you don't, or maybe it means you do something different. And so we can talk about that here towards the end. There are a couple of other things worth pointing out. So specifically, what if you already took your required distribution? Can you put it back? That's a pretty popular question. Sometimes people get right into January. They want to just get them done, have it over with, make sure that they don't forget. There are some ways to put it back. So the first of which is if you took your required distribution within the last 60 days, and this is not a new rule. This was not included in the stimulus bill. This is something that's always existed. If you've taken the money out within the last 60 days, you can simply just recontribute it back to the account you took it out. And from the IRS's standpoint, they will view that as a 60-day rollover and effectively view it as you never even took the money out at all. Now, there are a couple of technical aspects of that. So if you're someone who's considering doing that, then absolutely talk to your advisor to make sure that you get it done correctly and that it'll actually work and accomplish what you want it to do. But the clock's obviously ticking on that one because 60 days is 60 days. So every day that you wait, you're getting closer to not being able to do that. For inherited IRAs, unfortunately, that 60-day rollover rule does not apply. It's never applied. So if you've already taken your required distribution from an inherited IRA, then you're stuck. You're basically not going to be able to put that money back. The only exception is if the inherited IRA that you have came from your spouse. Then you have some different options. They're a little technical, so we won't walk through all of them within this presentation. But that's, again, another scenario where call your advisor and say, hey, what options do I have to put this back because I didn't really want to take this distribution, and now I can waive it. And the last thing that we'll add, and this probably doesn't apply to very many specific circumstances, but if you are considered a non-designated beneficiary, so something like an estate that has inherited an IRA, because for whatever reason the owner of the IRA listed the estate or didn't list any specific individuals, generally you're subject to this 5-year rule where you have to pay out the IRA proceeds within 5 years. They also are they're basically ignoring 2020 as a year. So now instead of being subject to a 5-year rule, you're subject to something more like 6. But that's pretty rare. Probably won't apply to very many people, but if it does, then that extra year obviously is helpful. All right, Paul, you want to walk us through some of the new rules for IRA withdrawals and some of the exemptions that people will get for that?
Yeah, so if you are impacted by the coronavirus, and that's a very broad definition that you can see listed below here. If you were diagnosed with it, that one's a clear impact. If a spouse or dependent was diagnosed, suffering adverse financial consequences due to layoff, reduced hours, furloughing of your position, if you're unable to work because of childcare as a result of the disease, or if you own a business that's closed or operated under reduced hours. If any of those apply, then you can take distributions from IRAs, employer-sponsored retirement plans, or a combination of the both up to $100,000. So this is a pretty big one. If someone has reduced income from COVID and they find themselves in a position of need, the government is allowing you to tap your retirement funds really with no consequences to get that money.
And there are some specific rules about taxes, penalties, withholdings, and repayments if you want to pay the money back. So let's walk through some of these. So not only can you take the $100,000, but from like an IRA or a 401k, but it'll be exempt from the 10% penalty. Now, as a reminder, that penalty usually only applies if you're younger than 59 and a half. So that's a nice little touch if you're younger than 59 and a half, that you can get money out without having to pay that 10% penalty. The income tax owed on what you take out will still apply. It'll still count as income, but being exempt from the penalty, which was sort of a secondary tax, is one that's really beneficial for people, because 10% is a lot. Normally, when you take money out of an employer plan like a 401k, they require mandatory federal tax withholding of 20%, whether that's right for you or not, which is kind of a big disadvantage for a lot of people, because most people don't actually owe 20% federal tax when they take money out. But they're going to waive that now. They're going to say there's no mandatory withholding requirement for 401k withdrawals. So that's nice. But here's where the real flexibility comes in, and I'd be interested in your thoughts on this, Paul. And there can be a lot of planning to be done with this. So when you take that, let's say you take $100,000 out, two things. Number one, they'll let you repay that over the next 3 years if you want. And they'll let you spread out the taxable income from that over the next 3 years if you want. So let's use an example, Paul. Let's walk through it together here. If you took out $90,000, just to make the math simple, it's true that you could say, I don't want $90,000 to show up on my 2020 tax return as taxable income. I could choose to have 30,000 show up this year, 30,000 show up next year, and 30,000 show up the year after that. Now, Paul, why would someone want to do that?
Yeah, well, taking $90,000 of additional income in one tax year is probably going to explode any individual's tax situation, regardless of their pre-existing income level. It will throw you into higher marginal tax brackets. If you were down paying 12% and you throw $90,000 of income on there as a allowed withdrawal under this new rule or this stimulus care package, you could easily find yourself in the 24% federal tax bracket, and that's not smart. Whereas you could potentially spread that 90,000 out over 3 years, as you specified, Steve, and potentially maintain keeping yourself in the 12% bracket going forward. So there's some planning to be done there. I would point out that if deciding to spread the withdrawal out over 3 years, it has to be done in equal pieces. So 30,000 year one, 30,000 year two. You don't have the option to do 60, 20, and 10 or any other combination.
Good point, Paul. So the second side of that is, let's say you took that 90,000 out And let's say that it's a couple of months from now and we've done an incredible job of creating new treatments and containing the spread of the virus. And fortunately, we make it through this, and the economy starts to recover, and your personal financial situation starts to get better, and you find yourself in a spot where you want to repay some of that money you took out of your IRA that you needed to lean on during these difficult times. My understanding of those rules are you don't have to repay it all at once, and you can repay it in multiple payments. And I don't think there's nothing I read that's been saying that it has to be like a consistent or equal repayments. So normally, when you take money out of your IRA, like we mentioned about those earlier rules, you've got about 60 days to replace it if you decide, oops, I didn't want to do that, or I can pay it back now. They're now saying you can take up to 100 grand out and you can repay it over 3 years, which is obviously much longer time frame. And I think this is part of the government recognizing that there's also a bit of a savings in retirement shortfall for the average American in the U.S. And so they're saying, listen, most people probably don't want to tap their retirement accounts, but if they have to, we want to give them ability to put that money back, because a normal IRA contribution, if you're someone who's saving, the limits are only $6,000 or $7,000 depending on how old you are. So to be able to put back, $25,000, $30,000, $50,000, $100,000 over the next 3 years, if you can afford to, is some really attractive flexibility if you find yourself in a tough financial spot right now. Anything else you want to add on that, Paul?
Just that the mechanics of it are interesting, and we probably don't need to focus on those in this. It's something to be discussed with your accountant. But I agree, as you said, everything I've read, you can pay it back whenever you want over the next 3 years in as many pieces as you want. It could be 1,000 one month, 100 the next, and at the end of it, you true up. But mechanically, to have it spread over 3 years, you either choose, I want to take the whole withdrawal as taxable income in this year, or spread it equally over 3. Then you start paying it back if you can, and that's unknown when you take the loan. And that may not be done evenly. So you could find yourself in a situation where you go backwards and amend a tax return. So we should keep that in mind, that there may be a little bit of additional expense and complexity, but not that difficult, and any good accountant will be able to cover that, no problem.
That's right. Yeah, there should be really some thought given to about, if I'm going to take this distribution under this new rule, how should I have the income treated? And then if I repay it, then there's some things I have to do, because I can go amend my tax return to say, hey, wait a minute, I paid some of that back, so I shouldn't have to pay federal tax on it. So that's a really good point, Paul. Okay, let's move forward onto the next piece there. All right, so 401k loans and deferred payments. So this is interesting. They're now allowing the maximum 401k loan to be increased from 50,000, the old limit, to 100, and it used to be up to either 50,000 or 50% of your account balance. Now it's up to 100,000 or 100% of your vested account balance, which obviously subtracts substantially more. So what's the government doing here? They're saying, listen, if you need to borrow money from your 401k from your employer, then we're going to let you do more of that. And we're also going to allow you to choose to defer your payments, even for loans that were taken out before the crisis started. Defer your payments for all of 2020 or up to a full year, which obviously is helpful if you're someone who is finding yourself in a tough financial situation, having to choose between, well, what do I pay? Do I pay my rent? Do I pay my mortgage? Do I pay my car payment? Do I pay my 401k loan back? If I have limited resources because I've been harmed by the financial downturn that's happened as a result of the spread of the virus, then now they're giving me a little flexibility on, paying stuff like this back. So that's a pretty helpful piece, I'd say. All right, let's jump into the big one, Paul. Do you want to walk us through the tax rebate checks? That's probably the biggest piece of all of this, the one that affects the widest swath of people, I think they're estimating 90% of the population will be eligible to receive these rebate checks. So do you want to walk us through the details of that?
Yeah, so good stuff here. The rebate check would be up to $1,200 for one person and $2,400 for a married couple filing jointly. You also get an additional $500 per child under the age of 17. So that person cannot be listed as a dependent on anyone else's tax return. So divorced couples, one of you is going to have to choose which one gets to claim that. So a married couple with a couple kids could be looking at a few $1,000s in potential stimulus check. Now, that amount is limited based on your adjusted gross income, your AGI, and it starts to phase out for a single individual at $75,000, and for a married couple at $150,000. The AGI number they're looking for will be based on one of two things: either your 2018 tax return, or if you have already filed your 2019, they'll base it on your 2019 return. There's no guidance from the IRS on if you look at your 18 and your 19 tax return and your 19 would get you a bigger check than your 18. There's no guidance from the IRS right now on if you can quickly file your 19 in order to sneak that number in there. So if that's the case for you, we would recommend filing immediately in hopes of getting it, but no guarantees. Ultimately, this is actually a 2020 refundable tax credit. What that means is that if you receive a stimulus check based on your 18 or 19 tax return, and then when you go to file your 2020, it turns out that you actually earned too much money to get this, they'll true up with you. But it's interesting in that if they already paid you, they will not take it back. This will only help someone who was not eligible for a stimulus check based on their 18 or 19 tax return. But then when they went to file their 20, it turns out they were eligible. They will at that point get paid whatever stimulus they were eligible for. Unfortunately, that's going to be like April of 2021, and by then the money probably won't help that much.
Yeah, that's a good point, Paul. The government's game plan with this really is to try and get this money as quickly as possible into people's hands. So let's talk about exactly how they're going to try and accomplish that. The first piece is if you have previously listed your bank account information on your tax return, either because you wanted a direct deposit of your refund or you wanted the money that you owed to be directly pulled from your bank account, then they already have your account information and they will try and deposit your rebate check directly to that bank account. Now, if that's the case, then we're expecting within sometime around the 3rd or 4th week of April for those deposits to happen. So keep an eye on that. Now, if they don't have that information, the next thing they said they were going to do was to create a website where you could provide that bank account information directly to the government. And so then they could make the electronic direct deposit to your bank account. Lastly, if you don't do that and you haven't already listed it on the tax return, then they're simply just going to mail a check to the address on file on your tax return. Now, as you can imagine, that's going to be the payment that takes the longest, and we might be looking at a couple of months for that payment. So, let's pay close attention to any updates about this website that they're creating if you have not already listed your direct deposit bank account information on your tax return in the past. And so that's a kind of an interesting logistical problem for them to try and figure out. But so let's jump into a little bit of the phase outs here, just to have a view on exactly where the lines end up being depending on different situations. So Paul talked about for single filers, anyone under 75,000 is getting the full amount, the full 1,200. For anyone that's married filing jointly under 150, now again, this is adjusted gross income. So this is your income before you take any standard deduction or itemized deduction. And for the head of household filers, anything under 112,500 will get the full amount. For every $100 over those limits, the rebate check will be reduced by $5. Now, if you have no kids, then that means if you're single, you'll phase out at 99,000. If you're married, you'll phase out at 198,000. But if you have kids, the phase out will be even higher than that because you have a bigger payment coming due. Paul already mentioned that it doesn't look like there's going to be any clawback for anyone who receives a payment, but technically in 2020 earns too much because, of course, again, this is based on your 2020 tax return, which obviously has not been filed yet because 2020 hasn't even fully happened yet. So it's interesting to note that. We already mentioned that it'll be paid to the bank account. So let's look at some charts that kind of tell us, okay, what are different scenarios here? So we kind of focused on a couple that's married filing jointly. So in the top left, if we look at a couple that's married filing jointly with 130,000 of adjusted gross income, they will get 2,400 as a married couple. And if they have four kids under the age of 17, so 16 or younger, then they will get an additional $500 per child. So it's another $2,000, and their rebate check would be $4,400. Now, what if their income is higher? If it's 200,000, then we have to do an adjustment, and effectively that adjustment brings them down to getting a rebate of only $1,900. If it's 225,000, then the adjustment is bigger, and that brings them down to a rebate of $650. And once they cross 238,000, then their rebate is basically completely phased out based on married filing jointly with 4 kids under the age of 17. So obviously the numbers can change depending on what situation you're in. If you're head of household with 1 child under 16 or under 17, then that's one scenario. The calculations, there could be a million different calculations depending on how many kids you have and what your income is. But if you have a specific question, again, I would encourage you there are some calculators out there. I know the Washington Post had a calculator. I'm sure more of those will pop up as people are trying to figure out, what exactly am I going to get? What should I expect? But if you have a specific question, you can always email or call your advisor here at Level, and we can help try and walk you through it as to what we think you might get. But the good news is the phase outs, are pretty high. So we think, that's where the government says, about 90% of people should expect to actually get some type of payment, whether it's in the next couple of weeks or next couple of months, depending on how you've listed your tax return and your bank account information. All right, Paul, do you want to walk us through some of the changes for charitable deductions and cash donations?
Yeah, a couple interesting changes here. I don't think they're going to have a huge positive effect for anybody, but every dollar counts. So despite all of our government's efforts to simplify the tax return, they've gone and added back another above the line deduction. This would be for $300 made to qualified charitable contributions in cash. It has to be made in cash. Donating clothes to Goodwill doesn't count for this one. So if you'll remember in the past, they had eliminated, they made it very difficult for people to itemize their taxes. They did that by capping the amount of state property tax that the SALT tax that you can deduct. And then they also did that by increasing the standard deductions to very high levels. So very few people were getting to itemize their taxes and therefore losing the ability to gain a little bit of tax refund from making charitable contributions. Now they're going to go back to allowing you to do $300. You don't have to itemize to do that. It just needs to be in cash. And really important to note here for many of our clients who do use donor advised funds, putting $300 into your donor advised fund doesn't count. It has to be in cash. It has to be directly to the charity. The other piece here, and this could be a little bit of a bigger one, is in the past, if you're donating cash for a qualified charitable contribution, there was an AGI limit based on how much you were allowed to contribute and still write off on your tax return. And I believe that was 50 or 60% of your AGI. So if you had a small income one year in retirement, let's say $40,000, your AGI was 40, but you wanted to make a really large charitable contribution of say $50,000, 30,000 of that wouldn't be claimable on your tax return because you were over the AGI limit. That's changed. I believe they've increased that to 100% of your AGI. Is that
That's
correct,
right,
Steve?
Paul. Yep.
Yeah.
Yep.
So that could be really big for people in retirement with low AGI on their tax return, but who are otherwise relatively wealthy and would like to make large charitable contributions in 2020 to whatever cause they think would help offset all of the pain that the coronavirus is causing. So that's an important one to know.
I would add too, Paul, that my understanding of this above the line $300 deduction is permanent.
Yes,
I think
great point.
we're looking for full confirmation of that, but my initial understanding of that is that it's permanent, which would be great because that's something that really obviously is going to affect a majority of people out there, because I think a lot of people, you know, they like to support the causes that people invite them to support. You know, a great example is locally the Ride for Roswell, right? You know, somebody's riding in it and they ask you for support and you donate $50, but that's not nearly enough for you to itemize, not even close. So you really don't end up getting any tax benefit out of that, but at least you supported, you know, Ride for Roswell, which is a great cause. Now you actually would be able to deduct and get a tax benefit from that contribution you make. And if it is permanent, then we're really talking about something that will make a small difference, but for a really wide group of taxpayers. I mean, virtually everybody who makes a contribution to anything. So that's good, right? That's a good thing to come out of this.
Yeah,
all right,
agreed.
Student loan.
No, you're fine. Go.
Yeah, student loan and grant relief. So this is actually a pretty big one for anyone who has student loans or anyone's kids who have student loans or grandkids that have student loans. They will be suspending all required payments on federal student loans through September 30th, 2020. Now, I think this was made retroactive as of early March. So basically 6 months worth of payments will be suspended. And not only will they be suspended, but no interest will accrue. And at the end of this 6 month period, that interest will not be capitalized back onto the loan. So it's not as if you don't accrue interest for 6 months and then all of a sudden they take that interest and just add it back to the principal of your loan, so you pay it just later. They just have you not pay it at all. So that's a fantastic deal, obviously, for anyone who has no student loans. We're going to talk about some of the planning opportunities that come with that later on in the presentation for people that have student loans. They also, but they're not making any changes to automatic payments. So if you have automatic payments set up on your student loans, you have to contact the lender or log into your account to stop those payments if you decide that you don't want to make those payments or can't make those payments and you want to use that money for something else. So that's a key one. They're not stopping automatic payments. You have to actually do that yourself. They are suspending all involuntary collections. So if you were already behind on your payments, they are suspending collections on trying to get you to make payments. So that's good for anyone who is already having financial issues. And the payment period, this is interesting. For anyone who is in any of the loan forgiveness programs, the payment period, even if you don't make payments over the next 6 months, will still count as payments towards loan forgiveness programs. So a lot of those programs require you to make 10 years worth of payments or 120 payments. And once you make that, if you qualify, any of the remaining balance is forgiven. Well, obviously, if you make no payments for 6 months, you may be concerned that that just means you have to pay 6 months longer to get into to qualify for these loan forgiveness programs. but they're going to actually allow you to count these 6 months, even though you may not technically pay anything. So that's really interesting. If you're someone who qualifies for that program, and we'll circle back to this at the end, you qualify for that program and you expect that you're going to, fully end up having some loans forgiven because you intend to keep qualifying for that program all the way through the end. Really probably shouldn't be making those payments if the loan's going to ultimately be forgiven anyways, and they're still going to count this 6 months. So that's kind of an interesting quirk there, but certainly helpful for anyone who qualifies. Also, if you are someone who is having your employer help contribute towards your student loans, which is sort of a new employer benefit we've seen pop up over the last couple of years because so many students are dealing with really large student loan payments. Typically, if employers had made student loan payments for you, it was counted as compensation. You would have to pay tax on it. Now they're going to exclude that. So that's obviously helpful for anyone who is receiving that benefit. Also, if you're currently in school and you're receiving a Pell Grant or subsidized federal student loans, usually if you drop out of school or don't finish this semester, then you might have to still have to pay the loan or still have to pay the grant back. This now excludes from a student's period of enrollment any semester that a student does not complete due to the qualifying emergency, which is of course a shutdown related to containment measures for coronavirus. And if the student withdraws from school during the middle of the semester because of this emergency, it eliminates the amount of the student's Pell Grant and cancels any direct loan taken to pay for this semester, which obviously may not finish because the student had to withdraw from school as a result of this. So there's some help for students who are kind of getting stuck here in the middle of this in a way where virtually everything that's happening is out of their control. So that's obviously good. Paul, do you want to walk through some of the changes to Medicare and medical expenses and how they count for different people now that they have passed this bill?
Yeah, so a couple interesting changes here. And my understanding is that some of these are permanent, specific to our first few bullet points here. So over-the-counter medicines, just buying Advil, Leave, various other items, now qualify as a qualified expense for HSAs, FSAs, and MSAs. That's health savings accounts, flexible spending accounts, and I just forgot what MSA is.
I think it's medical savings accounts.
And
yeah.
So over-the-counter medicines such as Advil, Leave, and various other items now qualify for HSAs, FSAs, and MSAs. That's health savings accounts, flexible spending accounts, and medical spending accounts. The definition of over-the-counter medicines will include amounts paid for menstrual care products, and the bill actually lists out several of those if you're wondering what's included. And also Medicare beneficiaries eligible to receive COVID-19 vaccine, that'll be at no cost. It's important to note that no vaccine exists yet, and the timeline for that appears to be a little bit longer, but when it does, the government's making sure that our Medicare recipients will not have to pay for that. Also important to note that Medicare Part D recipients are allowed to call and get a refill of their meds with a 90-day supply. So I think normally you'd be getting a 30-day supply every month, and right now they're going to simplify those people in that position, simplify their life, and allow you to get a 90-day supply all at once.
That's right, and they also now are making telemedicine and telehealth services, those rules are much more relaxed for Medicare and high deductible health plans, HSA eligible plans. Before you might have to face deductibles or limits on what might be covered with telehealth or telemedicine. Now, obviously, with people having to visit their doctors by, FaceTime or Skype, because they can't actually go into the office or the doctor doesn't want them to come into the office for safety reasons, you have to have big programs like high deductible health plans in Medicare be able to help cover some of those costs. So they've altered some of those rules as well. Okay, unemployment. They've made some really large changes here. And so I think we had a couple of questions come in about this in the survey we sent out. So let's walk through this. So they have created the pandemic unemployment assistance, which has now extended the benefit period out from 26 weeks to 39 weeks for unemployment benefits. It includes self-employed people and gig workers, so like an Uber driver, Airbnb host, a 1099 freelancer, things like that are now included, so it's widened the definition of who's included in that. So, you know, we had some questions specifically about that. That definitely is good news for all sorts of different people now. The federal government also is now going to cover the first week of regular unemployment. You know, traditionally there was been a 7-day waiting period where usually they want people to kind of spend a week looking for a job before they file for unemployment. Not anymore. Federal government's going to cover that first week. And they have increased the weekly payment by $600 for up to 4 months. Now in New York, Paul and I were talking about this earlier. I think the weekly unemployment benefit somewhere around $405 a week. So now you're looking at a little bit more than $1,000 a week if you add this benefit on top of the New York rates. We saw 2 weeks ago the unemployment benefits spiked from where they were before, which is, you know, $200,000 or $300,000, 200 or 300,000 people per week filing, to 3.3 million. And then last week there were 6.6 million people that filed for unemployment benefits. So people are obviously struggling. Businesses are laying people off. So these changes to increase the amount of unemployment, make payments start in the very first week, expand who's eligible to get it, and pay for a longer period of time will obviously help and make the situation a little easier to get through for anyone who finds themselves in that spot. So that's a really big one. That's one that we've seen a lot of countries do, some to bigger effect than what we're doing, some smaller. But obviously people are struggling and a lot of people are filing for unemployment. So this benefit is a big one.
Steve, I think it's important to note there that you need to make enough money to cover what you could get paid in unemployment. So if you make $400 a week in New York, they're not going to step in and give you $1,005 because there's 600 extra on top of that 405 limit. You're just going to get unemployment of the 400 that you lost.
Good point, Paul. That's a good point. It also, they're incentivizing states to create short-time compensation programs. So they're providing some financial benefits for the states that don't offer these programs to try and create them, which obviously might help people that are finding themselves in a temporary situation. So the federal government really is trying to further expand the programs and help the states expand their programs to help more people. All right, the planning opportunities, Paul. We got a lot of good stuff on here. So why don't you walk through the first one? Yeah, I don't know. The fun part is depends on who you're talking to, I guess. But for you and I, when it comes to strategizing and our CFPs at Level, we're always trying to think strategically about, okay, what are the rules how have they changed, and how does it apply to people's specific situations? So why don't you take us through this first one here? What are we talking about for those that have the ability to waive the required distribution? What are some things they should think about?
Right. So if you don't need the money and you're going to decide to waive your 2020 required minimum distribution, you may find yourself, or you will find yourself, in a situation where your 2020 taxable income is about to be lower because those dollars are not coming out of your IRA and hitting your tax return. If that's the case, as planners, we are definitely looking at the possibility of potentially converting some of your pre-tax IRAs over to a Roth IRA. That's a strategy we are always watching out for, and one that will start making sense for some people that it may not have in the past because their IRA distributions hitting their tax return was creating a tax that was too high. So that'll be a big one to watch out for. On the
Now,
similar
Paul,
topic, yes.
let me ask a question there that we hear often. Why weren't we recommending someone convert the required distribution before?
Great question. So you weren't allowed to convert an RMD. The portion of your money leaving your IRA to satisfy an RMD could not be converted to a Roth. So now if we're waiving the RMD, we can go look at traditional distributions, which are always eligible for a Roth conversion. It just doesn't always make sense to do that conversion based on tax strategy.
Right. Yep. So RMDs are not allowed to be converted to Roth IRAs, but now that they're waived, that gives you the flexibility to say, I can just take nothing, or I can convert what my required distribution was, or something less or more. I really have ultimate flexibility now, which is really, really nice. And actually, I have an anecdotal story on this. So we've been reviewing some situations on this. It's still pretty new, but we intend to walk through and contact every one of the firm's clients that has a required distribution to determine what option do they want to select and what do we recommend as their best, smartest option based on this waiver. But I saw a scenario where a client had I'll make up a number, I think it was something like a $30,000 distribution, and based on their personal tax situation, about 20,000 of that was taxed at 12%, and the remaining 10 was taxed at 22% because it pushed them into a higher bracket. So ultimately what we decided was that we will maybe not take the required distribution at all, but convert 20,000 to her Roth IRA, knowing that that will fill up the 12% bracket, but never cross her into the 22% bracket. And so that's some of the type of strategic thinking that we like to do when we say, well, when should we pay tax, right? If we now have all the flexibility because they're not requiring us to do anything, then when should we pay the tax? Should we still pay some now? Should we just pay it all later in the future? And I think there are two things there, Paul, that I want you to touch on. The first of which is a $2 trillion stimulus package on top of a $1 trillion federal debt load makes some people concerned about tax rates going up in the future. Can you touch on that deeper, and based on potential for tax rates to revert back to old ones?
Right. So when we're looking at Roth conversions as planners, the key piece that may drive us to utilize that strategy is your current marginal tax rate today versus your potential marginal tax rate in the future. And although we are not sages or Nostradamuses, it's a pretty big belief among most of our clients and among us that tax rates will likely be higher in the future. And given this current stimulus package, that's even more likely. So number one, tax rates will likely be higher in the future is the Tax Cut and Jobs Act passed December of 19, the Tax Cut and Jobs Act passed December of 18.
17, I think it was late 17. First came into effect in 18.
Oh, it was Secure Act. Yes.
Yeah.
So the first reason that your tax rates may be higher in the future is the Tax Cuts and Jobs Act of 2017, passed in December, lowered federal tax rates pretty much by 3% across the board on most of those tax rates. And those are set to sunset in 2025. So in 2026, we'll be back to the rates we used to have, which were higher. That one is pretty well gonna happen. It's already written into law, and it would take getting down the road to 2025 and having a lawmaker say, we don't want tax rates to revert higher. So that's probably gonna happen. The second reason we'll likely see higher tax rates in the future is this $2.2 trillion stimulus package on top of $1 trillion of federal debt already could potentially force us to raise tax rates down the road to pay off this federal debt that or this national debt that we're sitting on that's becoming quite untenable. So 2 reasons that tax rates will likely be larger in the future, and both reasons for us to more aggressively consider the Roth conversion tax strategy today.
All right, good. Yeah, that's a good recap. On top of that, I would add that low stock prices are an attractive time to potentially do Roth conversions. So let me go back to the beginning here in basics and just recap exactly what a Roth conversion is. It's where you take money out of your IRA and you don't put it in the bank account. You don't put it somewhere where you go spend it. You just shift it directly from your IRA to a Roth IRA. As a reminder, a Roth IRA is kind of the opposite of a traditional IRA, where once money's inside of a Roth, it will never be taxed again, no matter what it grows to. So let's say we did a conversion of $20,000 and investment returns were really good in the future and it grew to $30,000, and then you took all $30,000 out. You would pay no tax on the $20,000 because you already paid that tax when you did the conversion. And you would pay no tax on the $10,000 that it grew, because that's how a Roth IRA works. Also, it's good to know that if you leave a Roth IRA as an inheritance to your spouse or your kids, they don't pay any tax on it either. So it's really kind of a valuable type of account to have if you can get money in there in a smart way, because whatever the growth is, nobody pays any tax on it. So when we look at low stock prices, that makes the idea of Roth conversions even more attractive. And the reason being is, generally we try and, when building clients' portfolios, if they have different types of accounts, we try and put the more aggressive investments in a Roth IRA, because we know if those aggressive investments pay off, then all that growth will happen in the tax-free account, which is where we'd prefer it to happen, as opposed to an account where we have to pay tax on every penny of the gain in growth. So when stock prices are low, if you're of the mind that a recovery will eventually happen, whether that's 3 months from now or a year from now or longer, but if you're of the mind that growth and recovery will eventually happen, let's say that we converted $20,000 of shares of a stock fund, and those shares fully recover in the next year. Well, knowing that the stock market's down at the current moment about 25%, to recover, the stock market will have to grow, or the stock fund will have to grow 33% just to get back to even. So if I convert $20,000 that then grows 33%, I've grown that $20,000 to $26,600, and that $6,600 of growth is all tax-free. Now, if I had done nothing and just kept the $20,000 in my IRA and waived my RMD, I still would have recovered. I still would have grown that $20,000 back to $26,600, but the $6,600 of growth would have been all taxable when I took it out. If I had converted it and it then grew to $26,600, that $6,600 of growth would be all tax-free. So low stock prices means we can convert more shares to your Roth IRA and take advantage of what in the future may be a recovery, and have that recovery happen in the best possible place, which is a tax-free account. So there are kind of multiple layers there. It's a little confusing, but we do, I don't know what you think, Paul, what do we do, 30, 40, 50 Roth conversions a year? You think that sounds about right?
Yeah, I think maybe 35 last year, but the number just keeps increasing.
Yeah, and that's before this year's special circumstances, which is, a 25% stock market decline, a waiver of required distributions. So I would expect there's a reasonable chance that this year might go on record as the most Roth conversions we've ever done by the time the year's over. Would you agree with that?
Yeah, absolutely. I wouldn't be surprised to see that number at least double, if not triple. It'll be a busy year for us calculating Roth conversions.
All right, good. So we've talked about that one probably at full depth here. So let's move on to some of the other items. So delaying tax payment until July 15th. This is a pretty easy one. Let's say you had a unique year in 2019 and you underestimated your taxes and you owe the IRS $10,000. And right now that $10,000 is sitting in a bank account earning, 1%, let's call it. If you make your tax payment on April 15th, what the old deadline was, then obviously your $10,000 is no longer in your possession as of April 15th. If you hold on to that money for 3 more months, then at 1% on your $10,000, you would earn an additional 3 months of interest, which would be something like $25 to you, just for delaying for a couple of months. So I think, obviously anytime you have more money in your pocket and holding it as long as you can, especially if that money is earning interest, then the delay makes sense. And in fact, for my own personal situation, I'm doing that. Usually I file my tax return this week, first week of April. But I owe the IRS a little bit of money, so I'm not in any rush. I would like to hold on to my money as long as I can, earn as much interest as I can on that money, and I'll probably file my tax return in middle, late June or early July. So that one's a pretty simple one. Paul, do you want to talk about some of the opportunities for those that are under 59 and a half with these new IRA withdrawal rules?
Yeah, and on the tax payment one, I just add that potentially for some people more important than getting $10, $20, $40 of extra interest on their bank account by delaying that tax payment, it's just having more cash on hand for the uncertain. We're in some interesting times here, and if you can hold extra cash and get paid for it, you might as well. So for those of us or those of our clients who have IRAs or 401ks and are not yet age 59 and a half, they have the ability to take out up to $100,000 from that account penalty-free and stretch the tax over 3 years and repayment over 3 years if they so choose, as we discussed earlier. So this is a really good tool being offered by the government for people that are in need. If anything in your life has happened that you're going to need money for, this would absolutely be a much better place to get that money from than using credit cards or other high interest loans. We do want to keep in mind that America in general has a bit of a retirement crisis, and we don't want to tap these accounts if we don't have to. But if you need money, then this is a good place to consider going.
And for those that do get a rebate check, whether it's $1,200, $2,400, something else, what do you think are some of the things they should think about doing with that?
Yeah, great question. I'm sure the government would love for you to go buy a new couch or TV, assuming you can even get that delivered via Amazon, and stimulate the economy. But I think our suggestion would be, let's take a look at your emergency fund and making sure that it is big enough, or as big as we recommend, which is typically 3 to 6 months of living expenses. And also any high interest debt that you do already have. If you've got a credit card at 16% with any balance on it, getting a $1,200 or a $4,000 stimulus check, paying off that credit card would be a really smart move with that money, assuming your emergency fund is already properly funded.
Right. Yep. No, that's a good point. We've actually already seen some unique student loan scenarios too, where, back to the point we were talking about earlier, if you are not required to make payments for 6 months and you're not going to be charged any interest or penalty by not making those payments, if you have other forms of debt like high interest rate credit card debt or car loans or personal loans or any of those various things, you may actually find that taking the government up on that 6-month waiver for student loans and instead reallocating those same loan payment dollars to a more productive use like paying down a credit card at 15% interest, can be a smart move. So, if you're someone who has student loans, you should really give some thought about, if they're going to let me defer these payments or not make these payments for 6 months, what's the best thing for my situation if I have other forms of debt too? So there's an opportunity for some people to sort of be a little more efficient with how they use their valuable dollars. I would also say that, based on the tax rebate being implemented on 2020 income, if you are phased out of getting that rebate, that refundable credit, because your 2018 and 2019 income were too high, but you've been negatively affected in 2020, if you're close to any of those lines, those phase out lines, you may be able to manage your 2020 income in a way where you potentially are not phased out. So I'll use an example for a retiree, pairing back with these rules of waiving RMDs. So let's say that you're a retiree, married couple, and your kids are grown and out of the house, obviously. So it's just the two of you, and your income is $200,000 in 2018 and 2019. So you phased out. They don't send you a check. And let's say you had a required distribution of $30,000. Well, if you waive that in 2020, then your income will not be $200,000. It'll be $170,000. And if it's $170,000, then you're in the range where you should still get a payment. So you can think about managing your income for 2020 if you're in this unique spot where maybe you're phased out. But in 2020, you might not phase out if you're smart about how you handle your income for this year. And that's the unique thing that retirees usually have, and a lot of our clients have, is the ability within some range to control what income actually shows up on the tax return. And I would add, this is one of the questions that we received from our survey that we didn't answer earlier, but let me answer it now. These rebate checks are not based on whether you're working or lost your job or retired or any of that. They're really just looking at your tax return and seeing if your income was below the lines. It doesn't matter if you're retired. It doesn't make a difference. It doesn't matter if your income was zero. You will still get a check just simply because your income is below the phase out lines. So it doesn't matter what your actual working situation is. All situations basically count. It just comes down to what your income is. So we got that question. I want to make sure we answered that. And this brings us to the last point, which ties in with several of these different other points. And this is something we're doing in extremely large quantities for our clients right now. For anyone who has a non-retirement investment account, so just a normal brokerage account, if you have any investments that have gone down in value below what you actually paid for it, we will be doing what's called tax loss harvesting, which means we sell that investment for a loss. We use the proceeds to replace it with another investment just like the one we sold. So if that investment category recovers, you still recover. But in the meantime, you get to write off that tax loss. And those are extremely valuable. They can be used to offset other gains that you might have. They can be used to offset up to $3,000 a year of income from other sources like Social Security or pensions or IRA income. And any amount that's unused carries forward for indefinite periods. So there is no phase out of that carrying forward. So if you fill up all those buckets and you still have losses above and beyond all that, they just get used next year until you use them all up. That can help you qualify for these rebate payments because it can lower your income. It can help make these Roth conversions make sense because it can lower your income. So taking tax losses is, for us, really something that makes sense for virtually everyone that has it. And we've been taking a ton of those recently because the stock market has dropped so much. And we expect, it's hard to put a number on, but I tried to estimate earlier this year just exactly how much money in taxes in aggregate I thought our clients might save based on the amount of losses that we're taking. It's hard to put a total number on it, but I wouldn't be surprised, Paul, if we crossed like $200,000-$300,000 worth of taxes saved by taking losses. I mean, even if we took just $1 million of losses over all 630 clients and households that we deal with, even just $1 million in losses probably nets $200,000 of tax savings. Do you think that's fair?
Yeah, absolutely. And to some of our listeners here, it may sound a little crazy that we're talking about those kinds of losses, but you can't expect the stock market to go down and to not feel some of those. And it's our job to make the absolute best we can of this situation.
Yeah, it's really a silver lining. And when the stock market declines, you know, nobody roots for the stock market to decline. But if it does, and we have an opportunity to reduce our tax bill, it would be a prudent move to do that. And so we're generally doing that. If you don't have any these type of accounts, if your accounts are just for IRAs or Roth IRAs, then this obviously won't apply. So it's really only people who have these non-retirement investment accounts. So I think that basically has covered all the presentation. We want to thank you for joining us, Paul. Is there anything else that you want to add?
Not really. I think we just covered 600 of the 800 and some pages of that legislation. There are more business aspects. We wanted to stay away from that in this particular presentation, but if that does affect you, don't hesitate to call. We'll see if we can help you out. A lot of other people are ready to talk about it as well.
I agree, Paul. I think we covered a lot here that applies to individuals. I think if any of this is confusing or you want to hear more about, or if any of these planning opportunities you think applies to you, then I would suggest that you give us a call. You know, we're here to speak with everybody about their situation. So we obviously want to be here to help everybody sort out what makes the most sense for them. So feel free to give us a call at 716-634-6113. You can also follow us on our various social media channels. We're writing a lot these days, doing short little videos, retweeting links that we think are useful information from other sources. So follow us along in those different spots. And on behalf of Paul Coleman and everyone at Level Financial Advisors, I want to thank you for joining us for this webinar. Hopefully you found it useful and timely. And like I said, feel free to give us a call if you have any questions. Thank you.